Many high net worth individuals relocating to Portugal start with the same question: should I buy a home here? It's understandable. The lifestyle, the scenery, the quality of life, it all makes owning property feel like the natural move. But when you take a step back and assess the numbers, the logic starts to shift. Investing significant capital in a personal residence often results in dormant equity, while commercial real estate assets across Portugal are delivering consistent income, reliable appreciation, and increasing institutional attention. In this video, we'll look at why many investors are turning away from owner-occupied homes and reallocating that capital into commercial assets. We'll walk through the key real estate sectors: logistics, retail, hospitality, multifamily, and office, and explain the core drivers behind their performance. Let's be clear, buying a home isn't a bad decision. But for high net worth individuals, it's rarely the best use of capital. Residential properties purchased for personal use typically yield little to no income, and appreciation is modest in the luxury segment, often just 4 to 5% annually. Meanwhile, commercial real estate in Portugal is yielding between 5 and 7% annually in rental income alone, with strong occupancy and increasing demand across key sectors. The conclusion is straightforward: capital invested in income-generating commercial property stays active. It pays you, it grows, and it offers flexibility that owner-occupied homes do not. Lisbon currently ranks among the top European cities for rental yields, reflecting strong demand across both residential and commercial segments. But while residential returns may plateau, commercial sectors continue to offer institutional-grade performance. Portugal's logistics sector has emerged as one of the most compelling segments in commercial real estate. Fueled by e-commerce, nearshoring, and demand from retailers and distributors, logistics properties now command yields in the 5.5 to 7% range, with some assets achieving even higher returns in secondary markets. In the first half of 2024 alone, over 415,000 square meters of industrial space were leased, a 35% increase from the prior year. Vacancy rates in Greater Lisbon are close to zero. Many projects are pre-leased before construction is complete. This sector benefits from long-term leases with corporate tenants, triple net structures, and minimal capex, all of which contribute to stable, inflation-protected income streams. It's no surprise that logistics assets have become a core allocation for institutional funds entering the Portuguese market. Portugal's high street retail sector continues to defy expectations. Despite global headwinds in the retail space, prime shopping streets in Lisbon and Porto are thriving, driven by a surge in tourism, strong domestic consumption, and a scarcity of quality retail space. By Q2 2024, retail trade volumes were up nearly 3% year-on-year, and rents on Lisbon's prime avenues rose to €140 per square meter per month. Yields in this sector remain around 6.5%, but the real appeal lies in the location security. Core retail spots rarely come to market, and vacancy is effectively zero. For investors, this means stable tenants, predictable rental income, and a long-term appreciation profile. As tourism scales and international brands expand their footprint, demand for these assets is only likely to increase. Shopping centers in Portugal offer a more diversified, defensive form of retail exposure. Top-tier malls and retail parks report occupancies north of 95%, with long-established anchors and lease structures that index with inflation. Footfall has rebounded to pre-pandemic levels, or exceeded them in some areas, and large-format retail space is in demand from both national and international brands. Yields typically fall in the 6 to 6.5% range, and while capital appreciation may be modest, around 1 to 2% annually, the reliability of income makes this segment attractive, particularly for income-focused investors. Additionally, owning part of a shopping center reduces tenant risk. One closure won't disrupt your returns. And with consumer spending in Portugal continuing to climb, rental growth is still achievable in well-managed centers. Portugal's hospitality sector has become a standout performer. With nearly 30 million tourist arrivals in 2024, the country's hotel industry is operating at record occupancy and average daily rates. Investment into the sector has surged, with hospitality accounting for 23% of all commercial real estate investment this year, second only to retail. For investors, hotel assets can deliver 6 to 8% net yields in well-located markets like Lisbon, Porto, and the Algarve. The best-performing properties combine operational upside with real estate value growth. Importantly, investment models range from direct ownership to structured income arrangements, allowing for hands-off participation with reliable returns. Hotels are not only producing income, they're appreciating at a steady clip, driven by rising RevPAR and structural tailwinds in the tourism economy. Another strong performer, multifamily residential. Rather than owning one luxury villa, many investors are acquiring entire buildings or portfolios of flats aimed at Portugal's growing rental population. As of late 2024, the average gross rental yield for residential investments reached nearly 5.5% nationwide. And in cities like Lisbon, Porto, and Braga, occupancy remains above 95%. Demographic trends support this. Portugal's population is growing, urbanization is accelerating, and more people are renting longer due to high purchase prices. Multifamily assets allow for incremental liquidity. Units can be sold off individually or refinanced, and they provide inflation-linked cash flow in a stable, regulated environment. After a brief pause during the pandemic years, Portugal's office market is regaining momentum. In 2024, office take-up in Lisbon surged 77% year-on-year. In Porto, the figure was 38%. New developments are being absorbed quickly, especially in innovation zones and tech corridors. Occupancy rates in prime districts are now above 95%, with vacancy in Lisbon's core at just 3%. Prime office yields sit at around 6%, with upside potential as interest rates ease and rents continue their upward trajectory. Corporate tenants bring long-term lease stability, and opportunities exist to enhance returns through ESG upgrades or repositioning of legacy assets. As this chart shows, investor capital is flowing heavily into income-producing assets, especially retail, hospitality, and offices. These aren't speculative plays. They're strategic reallocations from global funds and experienced private investors who see Portugal not just as a destination, but as an investment market. Let's put this into context. A €1 million investment in a luxury home might generate no income and appreciate modestly, say 4 to 5% annually under ideal conditions. That same €1 million invested across commercial sectors can produce annual yields between €50,000 and €80,000. Add conservative appreciation, and you're looking at a 40 to 55% total return over 5 years versus 15 to 20% for the home. More importantly, commercial assets provide liquidity, optionality, and income, all while your lifestyle remains unchanged if you rent your residence. Portugal is a remarkable place to live, but living here and investing here don't have to be the same decision. Renting your residence keeps you flexible and mobile. Investing in commercial assets keeps your capital productive and diversified. Whether your goal is income, capital preservation, or long-term growth, the data from 2024 clearly supports a shift away from owner-occupied luxury homes and toward institutional-grade real estate. Live where you want. Rent the view, but let your money work every day in an asset that pays you back. To explore commercial real estate opportunities in Portugal, grounded in data, strategy, and long-term value, connect with Roca Estate. Visit rocastate.com to learn more.